What's up, YouTube? Travis, your stock geek here. I'm blown away by how many people seem genuinely interested in following along with the 100K portfolio. So all the positive feedback has got me really energized. And a lot of people keep asking me, are you going to talk about what's in the portfolio? Are you going to show us positions? Are you going to show us updates? And the short answer is yes. We're going to talk about that some today. I'll show you some of the positions in the portfolio. We're also going to talk market news, Palantir earnings, Trump tariffs. So let's just dive right in. If you watched my last video, you'll remember that I funded this portfolio with a fresh 100K in late October 2024. And as I'm recording here in the morning of February 6th, the portfolio value has grown to just over 104,000. And that's about a 4% return in the last couple months, which roughly matches the return of the S&P 500. And that's despite the fact that my portfolio is still only about 20% invested. 80% of the portfolio is still sitting in cash. My goal, of course, is to get the portfolio more fully invested by the middle of this year. And I always like to have a 5 or 10% cash position in my portfolio for the optionality in case the market does have a big pullback and I can add to existing positions or buy new positions that are on sale. You'll notice here that there's black boxes above the portfolio value. That's just a blackout I did to hide my account number for privacy purposes. Another note here, this change number, if you add it to 100K, doesn't match up with the total value here, and I'm not exactly sure why that is. I'm going to have to find out from Interactive Brokers. I think it could be due to stock commissions and fees not being deducted from the change number. So I'll have to find that out. I can also, by the way, pull in the real-time numbers here from Trader Workstation. I'll just go ahead and show you my portfolio value window here. And again, it's sitting actually just under 104K. So it can fluctuate by, a 0.5% or 1% right now in a given trading day, depending on what's going on. But so far, so good. Now, before we dive into some of the positions in the portfolio, I wanted to touch on a couple questions I got that relate to some very important concepts when it comes to managing investment portfolios. So Punakar mentioned that if you've got two portfolios and they both grow to the same ending value, but one of them has to pay taxes, that's going to be in a much worse position than a portfolio that's buy and hold. And he's totally right. Taxes matter a lot to your end result, to your net return as an investor. Here I show 3 different portfolios that all start at $100,000. One of them incurs no taxes. One of them has long-term capital gains tax rates it pays each year. And then one of them pays short-term capital gains tax rates, which tend to be higher, at least in the US. And so if you grow those over 30 years, the no tax portfolio gets to about 1.7 million in value. The long-term cap gains portfolio gets to about $1 million, and the short-term capital gains payer is getting less than $1 million after 30 years. So taxes matter a lot. Now, this 100K YouTube portfolio that I'm showing is an IRA, an individual retirement account, and so it does not incur taxes along the way. I will incur taxes when I take distributions at retirement. So I don't have to worry as much about making decisions based on taxes, but in my taxable accounts, I do. And it's really important to think about your holding periods. And sometimes I end up holding positions a little bit longer than I might otherwise in my taxable portfolios to hit that lower long-term capital gains tax rate. The other thing that's very important to touch on is contributions. Now, I'm not contributing to this 100K portfolio, or at least I'm not planning to here in the short run, because I want you to see a gauge of performance that doesn't get muddied by me adding new capital to the portfolio. But in my other accounts, I will be making contributions because they're so important. And I had someone mention in the comments, Vance mentioned that he's 22, starting with $1,000, wondering if he should follow a game plan similar to mine. Well, first of all, I don't want you blindly copying me no matter what. But the more important point here is that he's in an incredible position as a young person starting investing at 22. So it almost doesn't matter what he does strategy-wise as long as he doesn't blow himself up or blow his portfolio up. As long as he's making contributions along the way, that's going to be just as important, if not more important, than what he's doing with his actual investing strategy here, because he's got so long to let that portfolio compound and add contributions and value. So here you can see a graph, for instance, of $200,000 portfolios over 30 years. Again, if you make no contributions, you end up at about 1.7 million here. But if you're just making $5,000 contributions each year, growing with the rate of inflation, which are relatively small relative to the overall portfolio, that portfolio is going to compound on that and over time get to almost $3 million if you're just making modest contributions. So contributions often matter just as much as returns, if not more so if you're a younger investor. Very important to understand that. In my last video, I spoke a lot about trying to find these long-term compounding stocks, and Krishna asked in the comments, well, what's your approach to finding long-term compounders? Not the ones that did good for the last 20 years, but the ones that are going to be compounders in the future. And that's a really, really great question to ask. And I spend a lot of time thinking about this and a lot of my investment strategy focusing on this. Now, if we do look back and look at some of the best compounders, I charted some here, companies like AutoZone and Intuit and Danaher and others. The median return over the last 10 years for this group of stocks is about 400% and about 1,500% over the last 2 decades. So if you're able to find these in their early phases, they can really transform the value of your portfolio. But what can we learn from this group of past compounders to help us figure out how do we find the future ones? Well, there's actually been some great books and studies done on this, and one of my favorites is this 100 Baggers book by Chris Mayer, and it goes through a lot of the common characteristics that they've found among these past multi-baggers. Some of those characteristics include companies that start their long-term compounding typically are lower market cap and lower valuation at the beginning. So you really want to find them when they're relatively small, relatively unknown, and relatively low priced as far as valuation is concerned. And we'll talk a little bit more about that. The other thing that's important is a management team that's really good with capital allocation. So they're not out there making stupid acquisitions and overpaying for things. They're not out there issuing too much stock. In fact, oftentimes what they're doing is they're buying back stock when the stock is cheap, or they're investing in growth initiatives that really pay off. And so a lot of these compounders are going to have a really good, solid management team when it comes to continuing to drive year after year those returns for shareholders. Again, we'll talk a little bit more about that, but these are some of the characteristics. To further drive home the point of what compounding can look like in action, let's look at a classic compounder, AutoZone. A kind of boring business. They own a chain of auto parts stores around the US, but over the last 20 years or so, they've consistently grown revenue. They've consistently grown cash flow. And management has done very smart buybacks at the right times when the stock was cheap and reduced the share count from about 80 million shares 20 years ago to less than 17 million shares today. And what that does is it allows the existing shareholders to own more of the business over time. And so free cash flow per share that's available to pay out to shareholders has grown even faster than revenues and cash flow itself. So in the last 20 years, AutoZone revenues are up about 3.3x, cash flow is up about 5x, which is great performance, by the way. But the share count is down 80%, leading free cash flow per share to grow by 23x. And so that has also led to the shares growing more than 30x because you've also had a little bit of valuation multiple expansion on top of all of this. So if you get growth in revenues and profits and reduction in share count, growth in free cash flow per share, growth in the valuation multiple, you can have a massive return. Now, if all compounders were as obvious as AutoZone, perhaps investing would be a lot easier, but it can be a lot messier in real life. Take NVIDIA, for example. 2008 through 2013, NVIDIA really didn't grow. Its stock price was down. And then 2014 through 2024, NVIDIA exploded. The stock was up more than 330x. You could have turned a $3,000 investment into more than $1 million. Pretty amazing. But would you have been able to spot NVIDIA in 2010? So how do we find these future multi-baggers? There are a bunch of different ways. I talk a lot in depth about these different methods in my stock investing bootcamp, which I'm going to do this year. It's an 8-week bootcamp. If you're interested, I'll put the waitlist link in the description. But here's just a simple screen using some of the 100-bagger book criteria. Low market cap, revenues growing over the next couple years above 15%, positive profit margins, and a valuation that's not excessive. And you can see here on Koyfin some of the stocks it spits out. This is just the beginning of the research process. You're going to have to weed out some real dogs in this list and figure out which ones actually have the potential to have that sustained growth, which ones have the management teams that understand how to drive shareholder value long term. And so this is just an example. I do have one of these companies in my portfolio. We'll talk about that in a minute. Okay, let's talk positions in my current portfolio. So you might look at this portfolio and say, this is a weird looking portfolio. There's some stocks in here, if you look at the long-term charts or the multi-year charts, that kind of look like dogs. Energy stocks, Chinese stocks, or value plays like Etsy. It looks like stuff that hasn't been working in the current market over the past couple of years. But that's precisely why I own some of it, because I think there could be some changes coming in both sentiment and fundamentals for some of these stocks. But let's talk through it. Etsy, the largest position here in the portfolio at about a 5% current weighting, which is a reasonable size position for me, but certainly not where I would max out. If I get really comfortable with something and think it's really undervalued, I might make it as much as a 10 or 12% position in the portfolio. Right now, I've got some room to add if I see the right situation with Etsy, but it's still a good size position. So Etsy. Etsy, if you look at the long-term stock chart, it doesn't look great over the last couple of years. The market kind of hates the stock because, as you can see, revenues have really flattened out. They haven't been growing revenues very much over the last couple of years. They grew revenues rapidly during COVID, and it was a great stock to own then, but the last year or two has not been. So the question is, will it ever grow again? Because the market is almost saying that it's never going to grow. You can see they've done a little bit better on the bottom line and improving cash flows and margins. This company generates almost $700 million of free cash flow a year, and it's got a $6 billion market cap. So it's trading for less than 10 times free cash flow. And it's a very good business model. It's a marketplace business, CapEx light, and it's a high margin profitable business. So the real question is, can it ever grow again, and will the market give it credit and give it a valuation multiple expansion at some point? The other thing to note here, by the way, is the share count. Etsy management has been buying back shares recently, which is helping reduce the share count, and that will also lead to a growth in free cash flow per share. And so if that continues, that will be a nice tailwind. And I think the market may be missing something about Etsy here. Number one, Etsy had a huge COVID boom, and obviously there's going to be a period afterwards where it has to digest slower growth rates. The housing market is also weak, and the housing category and home goods category for Etsy is pretty significant. So they're weathering a storm in part of the business right now. And I think once that eases off and we get to a more normalized housing market in the next couple of years, Etsy will be able to show better growth rates again. Management's also working on some initiatives to really push forward in certain areas like gifting and areas of the platform where maybe they can wring some more growth out, even if the housing market stays stagnant. So I think Etsy will be able to grow again. It may not happen this quarter. It may not happen next quarter, but I do think it'll grow again. The sentiment will change, and it's a great business model and a very unique platform, and you're getting it for a very cheap price. So that's what I like about Etsy, even though the stock chart looks like death lately. Of course, I bought it here. Did I catch the bottom? We don't know yet. Hopefully. We'll have to see. But another position in the portfolio, First Solar, third largest position currently, this is a stock that I have a long history with. We actually shorted this stock like 10 or 12 years ago at the hedge fund and made money on it when solar was collapsing because of Chinese competition. But First Solar, to give them credit, has done an amazing job over the last few years of improving the business and really carving out a niche in the North American utility solar sector. And solar has become a dominant part of the energy mix in certain states and certain regions. And First Solar, being the only U.S. domestic manufacturer of scale, has a really good position in the utility solar market. You can see the revenue growth rate here in the chart has been quite nice in recent years. Some of that has been because of government subsidies from the Inflation Reduction Act, which is a funny name for a bill that is going to spend hundreds of billions on alternative energy. But you can see cash flow and margins have also improved a lot in recent years. So we're looking at First Solar trading at a single-digit multiple of earnings estimates this year at a time when we think there could be significant increasing demand for solar, even in a world where some of the subsidies get cut back. There's so much demand for AI power and AI infrastructure that solar is likely to be at least part of the energy mix because it can be built quickly. Nuclear plants and gas plants can take 5 to 10 years to build, and so a lot of these big AI facilities are going to need more power, and solar can at least provide some of that. So I think First Solar has a pretty good position in the industry. They're building out new plants domestically. They're also enjoying a very, very nice multi-billion-dollar backlog that stretches out to like 2028 across the globe. So I think the stock is being overlooked because of fears about the subsidies going away. And I think it's likely some of those will go away, but I think First Solar can grow through it. So that's what I like about First Solar. Again, I could be wrong on any of these positions. I will be wrong on some of these positions. So just understand that as I'm talking through all this. Now, energy names. I've got Equinor, which is a large Norwegian energy and gas integrated company, and Devon Energy, which is a U.S. domestic player. Both of these stocks look really cheap to me, and both of these stocks actually provide a dividend yield, which is nice. Equinor, in fact, provides me a double-digit dividend yield, so even if the stock goes nowhere, I can earn a pretty good return on it. I think energy also plays a really nice hedge role in a portfolio because if you're worried about an inflationary scenario, energy stocks can provide a really, really nice hedge and a really nice gain potential in a situation where we do get much higher inflation or some runaway inflation scenario. So they're also kind of a geopolitical hedge as well, and they tend to be less correlated to other positions like tech in the portfolio. So I like to have a little bit of energy in the mix. You can also see I've got some Chinese stock exposure. Now, this one is going to be, a little bit maybe controversial because the U.S.-China relationship has broken down quite a bit in recent years. We know the Trump administration is putting tariffs on China right now. So as a U.S.-based investor, there's kind of unique risk for holding Chinese stocks. We look what happened with the Russia-Ukraine situation a few years ago. All the Russian stocks that were trading on U.S. exchanges got delisted. So that is kind of a gray swan, black swan risk existing with Chinese stocks for a U.S. investor like myself. But that's also why I size them small. So I think Chinese stocks can outperform this year because the Chinese are going to initiate significant consumer stimulus. They have already targeted stimulus in the banking sector and in their market sectors. So I think that will help. And Chinese stocks are trading at fractions of the valuations of their U.S. tech counterparts. And companies like Alibaba also have an AI component as well. Now, Tiger, Up FinTech, the name of the company here, is a company that is basically like a Robin Hood of China. So they have a pretty slick app that people in Southeast Asia use to trade stocks. And I think that could be a direct beneficiary if we do see a big uptick in the stock prices in the Chinese market. So both of those will play on an improving China market this year. And we'll see how that plays out. There's probably going to be some volatility involved, obviously, as we go through the trade war. But I do like those as a nice contrarian play. And again, something that's going to be a little bit less correlated to my US positions. That brings me to Coinbase, which is the 5th largest position in my portfolio and maybe not quite as contrarian as some of my other positions. But I do think Coinbase is being underestimated by the market, both short and long term. Long term, I think Coinbase will be a much larger company than it is today, say 10, 15, 20 years from now, because Coinbase is building out all sorts of different revenue streams in the crypto ecosystem. So even if we go through crypto cycles, I think overall they'll be able to grow in the long term. You know, they're building things like Base, the level 2 Ethereum ecosystem, where people are building meme coins and other services on top. And they've got the institutional side of the business where they're servicing ETF clients, the Bitcoin ETFs and other crypto ETFs. They may even have a role in the strategic Bitcoin reserve. They also serve institutional traders in crypto, and we know that there is a lot more institutional volume flowing into crypto and a lot more institutional acceptance. So I think things are going pretty well for Coinbase, and there's a lot of opportunity ahead if they keep executing well. The other interesting thing shorter term is that I think Wall Street analysts are asleep at the wheel when it comes to what they're estimating Coinbase can earn, both in 2024, because we'll get the fourth quarter report here in a week, but also in 2025. If you look at the earnings estimates for 2025, Wall Street analysts are basically saying right now that they think Coinbase earnings per share are going to decline almost 20%, as if they're calling sort of the end of the current crypto cycle. And they're also saying basically that Coinbase won't be able to grow their earnings per share in 2026 as well. That feels a little bit pessimistic, particularly since we're already in the first quarter of 2025 and we know crypto volumes have still been pretty good. The other thing that's interesting here is that for the fourth quarter, which again gets reported next week, analysts are currently estimating Coinbase will put up about $1.7 billion of revenue and about $1.50, call it, of earnings per share. I've run some math that suggests that Coinbase could do well north of $2 billion in revenue for the quarter and potentially as much as $4 per share or higher of earnings per share, meaning they'll do $10+ of earnings per share for the full year of 2024. And what does that mean for 2025 if they grow from there? So Coinbase goes from trading at what it looks like a 40 or 50 times earnings multiple to perhaps less than 30 times if you update the numbers. And Wall Street analysts could end up in a situation where all of a sudden they've got to scramble to up their earnings estimates. And what does that mean for the stock? Well, there's been some great research out there that suggests that when you have these cycles of earnings revisions higher, where analysts are upgrading their earnings estimates, that tends to lead to really good returns for stocks that are having those earnings revisions. So Kevin Muir, who writes a great Substack called The Macro Tourist that I subscribe to, posted this chart in a research piece that he did about factor returns. So quant funds, algorithmic funds that invest solely in baskets of stocks that have these positive earnings revisions have seen great returns over the last, say, 2 decades by using the strategy to invest in stocks that have increasing positive earnings revisions. And so Coinbase could be in that bucket of stocks here just in the next couple of weeks and months if I'm right about the Wall Street analysts being too low on their estimates. So I think that could be in favor of Coinbase stock moving higher in the shorter run as well. In my list of portfolio holdings, you'll notice that there's a black bar here, and that's because I've got a position that I just started adding to this week, and I'm not yet ready to talk about it publicly, but hopefully in a future video. Now, beyond the stocks that are in the portfolio, some areas that I'm looking at and some areas I'm researching where I may add some stocks that fit these themes, AI agents. That's an area that's obviously becoming very hot with some of these new models like O3 and deep research coming out. We're seeing AI applications that are able to take multiple steps that look more like humans in terms of the workflows that they're taking care of. And so AI agents is a very hot theme, and there's some stocks that could fit in there. There's also autonomous vehicles and robotics. These are, of course, large potential addressable markets that are maybe just on the front end of growth. And of course, there's going to be some overvalued stuff and maybe some stuff that is sort of like pretending to be robotics companies that don't have as many capabilities. So you got to be a little bit careful in some of these futuristic areas to watch out for minefields and frauds. But I do think there's some potential plays there. And then, of course, there's trade war beneficiaries. So if we do see intensifying trade wars, there's some areas that I think could benefit and could be stocks that win because of that. And then housing market recovery plays. I don't know that we're on the cusp of a housing market recovery in the U.S., but I do think by 2026 and 2027, we should hopefully start to see a recovery or a normalization in the housing market. And so I want to get ahead of that by looking at some of the potential winners from a housing market recovery in the US. And then battery tech. If some of these other futuristic areas really start to play out, particularly in AI and robotics, we're going to need a lot more batteries. And hopefully we'll also have some battery breakthroughs that provide, faster charging times, more capacity, things like that. So I am researching some of the battery tech stuff, although it is a little bit frontier right now. Now, general themes that I'm always researching: companies that are seeing insider purchases, companies where the company is ramping up share buybacks, particularly when they're trading at reasonable or low valuations, companies that could be buyout candidates. I do think 2025 is going to be a much bigger year for potential M&A because we have a new administration, and hopefully they won't be challenging as many deals as the last one. We'll see how that plays out. But M&A could be a bigger deal in the markets this year. And then potential areas where there's are companies that are improving margins quickly. So those have been some of my bigger winners over the last couple of years. Companies like Spotify, where it looked like they had a really good growth in users and revenue, but they just weren't being efficient. They'd hired too many people, and they just needed to get religion when it came to costs. And we saw that with both Spotify and Meta and some of the other big techs as well. And I was able to pick up those stocks when they were very, very depressed in 2022 and early 2023. And so I'm still taking profits in those and some of my legacy portfolios. But finding companies like that where you can really get a big, fast improvement in the earnings power can be a really interesting area. And so that's definitely a place that I look. And then also companies where they're actually growing, but the market is treating them like they're not growing or like there's some existential problem. And a lot of times what happens is, the companies just have to prove over time that they can get over some competitive concerns or, really prove out that that something the market is worried about is really not worth worrying about. So that's another area where I've often found really good stocks, and I'll be continuing to dive into that. All right, let's talk about some of the stuff happening in stock markets right now. So one of the big headlines late last week, early this week that caused a lot of volatility was the Trump trade war 2.0, the tariffs that he threatened to put on Canada and Mexico and China. He walked back some of those tariffs on Canada and Mexico, at least after talking with those presidents and getting concessions from them. So we had this seesaw where the markets were down, then the markets recovered. And really, ultimately, what it means, I think from a high level, is that the Trump administration brings a lot of uncertainty when it comes to certain policies, a lot more volatility than maybe we've seen in the recent past. And so even though Republicans in the Trump administration are pro-business and they're bringing pro-business policies to areas like AI and crypto and deregulation, they also provide a lot of uncertainty. Take, like, say, inflation and interest rates. On the one side, you've got DOGE cutting government expenses and trying to cut out potentially even whole departments. And that could actually be seen as creating some pressure on the overall economy. But on the flip side, if they're bringing the budget deficit down, then that could actually lower interest rates, which could have a stimulative effect. And so what's the net effect of all those things? Really hard to figure that out right now. And ultimately, what I've decided is I don't want to try to predict every single thing that's going to happen. I just want to react and use it to my advantage. And so if you look at the market corrections in the S&P during Trump's first term, you can see that there were a bunch of corrections, particularly in 2018, 2019. Then, of course, we had the big correction during COVID in 2020. But the point is, I think we're going to have a lot of these knee-jerk reactions by the market to things that are happening in the Trump administration. And so that's going to give us opportunity to add to our favored positions or add new positions at better valuations. And that's what I'm going to try to do. On a more micro level, we're in the middle of Q4 earnings reporting season. So we're getting earnings from a ton of companies, and we're getting 2025 guidance. One of the bigger stories of earnings season so far has been Palantir. They delivered a pretty fantastic earnings report. The stock gapped up more than 20%. It's up over 400% in the past year. Pretty wild to see that. Their own press release said they eviscerated consensus estimates. I thought that was funny that they used that term. But certainly no doubt that it was a great quarter. If you look at some of the highlights, growth in the US and growth in the commercial side of the business was super rapid. That's actually impressive to me that they're growing so fast outside of the government sector. It's not just that they're winning government contracts. They're winning big, big contracts in the commercial side with private businesses, and that's pretty impressive. That brings me to the freezing cold take of the week, by the way. This person on X posted and said, for those who can read cash flow statements, you'll see below that Palantir doles out more cash in stock comp than it generates in net income to the tune of hundreds of millions each year. Well, for someone who's talking smack about reading cash flow statements, they clearly don't know how to read one. Let me just show you what I mean by this. So net income is from the income statement. And on the income statement, in these operating expense lines like sales and marketing, R&D, general and administrative, within those lines, you have what's called stock-based compensation expense. And that's an expense. It's an accounting figure used to try to capture the economics of a company that issues stock to its employees. But when a company issues stock to its employees, it's not handing them cash, it's handing them shares. So even though the income statement tries to account for the economics of handing employees shares, it's not actually a cash expense. And so if you look at the cash flow statement, which actually shows cash in and out of the business, the way that it works is you start with net income, which comes from the income statement, and then you add back any non-cash expenses to arrive at what the cash flow generation of the business is. So you have net income here for Palantir in 2024 was about $468 million, and they had a massive stock-based compensation expense of $700 million, which again was already deducted on the income statement before you arrived at net income. But you add it back on the cash flow statement, and what you result in is seeing that Palantir generated more than $1 billion of cash flow in 2024. So Palantir is a very profitable and cash generative business. And yes, it's also issuing a bunch of stock to employees, which will show up in an increase in the share count and an increase in dilution. But it's not paying out more cash than net income. It is actually generating a ton of cash. And so one thing that Ross is right about, though, is that Palantir is trading at a very, very high valuation. In fact, it's very much an outlier relative to other SaaS companies in the market. It's trading at the highest EV to sales multiple by far and trading at something like 100 times the earnings estimates for 2027. And of course, analysts do estimate Palantir will continue to grow quite a lot, and maybe Palantir will beat these estimates. But still, you're trading at a very high multiple of earnings looking out a few years. And that's the major reason why I don't own Palantir, even though I admire the company. There is such a thing as overpaying for growth. Here's a perfect example. Intel, during the dot-com boom, was growing like a weed, growing so rapidly, and it looked like it would continue to grow and grow and grow and grow. And yet, if you paid too high of a price back here in 99 or 2000, you could have had negative or no returns for like 20 years. And that's at a time when Intel actually grew revenues and profits. You can see they more than doubled revenue and profit during the 2 decades after the dot-com bust. And they actually bought back stock as well. They were doing all the right things and growing nicely, but you wouldn't have had a good return because you overpaid if you'd bought it in 99 or 2000. So there is such a thing as overpaying for growth. And that's why I don't own Palantir today, although perhaps one day I'll be able to buy it at a better multiple. Looking at some other companies that have reported this week, Uber. Uber was kind of the opposite reaction as Palantir because the stock fell like 8% despite delivering really good results and really good growth. They grew gross bookings at more than 20%, revenue at more than 20%. The bottom line grew even faster. In fact, adjusted EBITDA grew at like 60%. And they had a lot of really interesting things to say about their partnership with Waymo. They're going to be rolling out a new partnership in Austin and Atlanta where you're going to be able to order Waymo rides or autonomous vehicle rides on the Uber app. And so I thought that was a really nice partnership there. But despite that, the stock fell. I think investors wanted to see, I guess, more growth for 2025 forecasted. They also are still worried about the threat of autonomous vehicles from Waymo and Tesla on the long-term future of Uber. I think that could be a little bit short-sighted given that Uber's got this great partnership with Waymo, and it is going to take quite a while for autonomous vehicles to roll out, and AVs are probably going to be a premium price product for a long while. So I thought the reaction was maybe a little bit overdone on Uber, but nonetheless, it was interesting to see the market react to what I thought was a pretty good report. Now, when you look at Uber's competitor Lyft in the rideshare market, it's doing even worse in terms of its performance and its valuation. Lyft is trading at a significant discount to Uber and a significant discount to the overall market, even though Lyft has done a pretty good job over the last couple of years of increasing margins, and it's still growing gross bookings at over 15%. So it'll be interesting to see what their guidance for 2025 looks like, but I would guess that Lyft is probably even more at risk from AVs since they don't have as strong of partnerships as Uber does currently. Now, Lyft has also been rumored, though, to be a potential acquisition target. Maybe some vehicle manufacturers want the network that Lyft has, the existing network and app, and that could be a really interesting way to add the capabilities of rideshare to the AV business because Uber, for instance, sees that those two are going to be really complementary for the years ahead. So Lyft, I think, could also be interesting here. Both stocks in this duopoly of rideshare are looking quite beat up and maybe potential interesting values. Now, moving on to some of the big tech stocks, Google and Meta, really interesting to see the dual reactions here because Google delivered a pretty good quarter. They increased revenues 12% year over year, bottom line increase over 30%. So Google's still, doing a pretty good job with efficiency and having margins improve, and EPS growth was over 20%. So that's all good in terms of the existing numbers. But they said something in the press release and in the conference call that spooked investors, and that's that Google is going to be increasing its CapEx by almost 50% year over year on more AI spend. You can see the ramp of Google's capital expenditures over the last couple of years. This is a very significant step up in capital expenditures and growing much faster than overall revenue and profit are growing. So this is starting to spook investors that Google maybe is losing its way on costs and spending again. And there's a questionable ROI on a lot of this AI spending today. Google, of course, thinks that they have to spend this and that it's like existential, and it very well may be, but the market is going to want to see a return on Google's AI spending at some point. Somehow, though, the market seems okay with Meta's massive increase in CapEx spend. You can see Meta is also having a huge 50% step up in CapEx year over year, but yet the stock price is up 20% year to date versus Google stock, which is roughly flat year to date. So I guess the market trusts Meta to actually get an ROI on its CapEx spend a lot more than Google. Perhaps it's that Meta moves more quickly, or Mark Zuckerberg has a lot more cred or street cred with Wall Street right now. But very interesting to see the different reactions in the AI spend step up. Either way, both companies are going to have to prove over the next couple of years that this AI spend can actually deliver some ultimate return to shareholders. And this could be a headwind for earnings growth for both Meta and Google in the next couple of years. So it'll be interesting to see how the market reacts to the earnings headwinds from this increased CapEx. That brings us to PayPal, which is a stock that I did a big deep dive on last year. You can go find that video. I talk about some of the competitive threats and opportunities for PayPal. PayPal delivered 21% growth in non-GAAP EPS in 2024, which is very good bottom line growth, but revenue only grew in the fourth quarter by 4% year over year. Transaction volumes did grow about 7%, and they are still growing active accounts at a low single-digit percentage. So this thing trades for 15 or 16 times 2025 earnings estimates after the fall, after they reported that earnings that disappointed the market. It's not expensive. It trades for an even lower multiple of free cash flow. I think it trades for something like 11 or 12 times free cash flow. But the real question for investors is, how are you going to grow earnings if revenue really starts to slow down, if you can't re-accelerate revenue growth? Because even though you had 21% earnings growth in 2024, PayPal is only forecasting an 8% earnings growth in 2025. And if the top line doesn't reaccelerate in terms of growth, then they're going to have trouble in the years ahead growing the bottom line. So that's where the market is, not really sure what the future of PayPal looks like. There's a lot of competition in payments, both in the B2B side in Braintree, but also in consumer, and of course, threats like Apple Pay for PayPal. So PayPal's got a lot to prove still. I do like the CEO, Alex Chriss, who took the helm last year and is really pushing forward on initiatives in the SMB space and unlocking some monetization opportunities in Venmo and Braintree. And I still think the company's undervalued, but it's something that I own a little bit of in my legacy portfolios, but in this 100K portfolio, I don't own it yet. I would probably be a buyer, say around the 50 or maybe sub 60 level, where it starts to get really cheap, trading at a single digit multiple of cash flow. And then, you don't have to worry as much about whether or not they're going to be able to massively reaccelerate growth. You're just buying a cheap stock for a good multiple. And I think they'll continue to buy back stock at the right prices. They authorized a $15 billion buyback here at the end of Q4. And so that's nice to see as well. Management hopefully will take care of shareholders and continue to push things forward. And maybe, just maybe, if they can reaccelerate growth, they can prove to the market that this is a better business than the market thinks it is. So potentially, a good future for PayPal, but definitely some questions in the air. And speaking of questions, that brings us to our question of the week, which I pulled from the stock subreddit. And this person posted this right around the time the market was selling off with the negative tariff headline news. And they asked, should I go to cash? Should I sell all my stocks with all this uncertainty? I just can't see a positive outcome happening. And of course, with the benefit of hindsight, we know the tariff issue ended up being short-lived and the market rallied very quickly afterward. But this question, should you go to cash in a time of uncertainty? Well, we have a lot of data from studies in the stock market to tell us that most people are really bad at market timing. And this is a really bad idea to try to sell all your positions for a number of reasons. One is that it turns out that during times of extreme fear, when the market's already sold off, the forward returns from there actually tend to be quite good. The opposite is also true when you have investors bragging about their portfolios and investors are all over the covers of magazines and everyone thinks you can't lose. Those are the times when forward returns tend to be pretty poor. And so even though we always say, you should go against the herd as an investor, most people don't, and they end up doing the exact opposite of what they should do. We also have studies showing that buy and hold investors tend to, on average, perform better than investors who try to market time. And if you miss the 10 best days in the market, ultimately your returns, and this is over a multi-year period, by the way, your returns will end up being much, much lower than if you just stayed invested through the cycles. And the reason for that is that the 10 best days often cluster around the 10 worst days. It turns out, and if you look at, say, 2020 or GFC, you can see this. Some of the biggest down days in the market are often followed by bounces where you have really, really nice up days, even in a bear trend. And so what that means is if you're selling all your stocks on a really negative day for the market, you're basically selling the bottom or locking in negative returns or locking in poor returns and then missing the upswing, you could end up really impairing your portfolio or getting suboptimal returns. The other risks of overtrading are that you could generate a ton of taxes. If you sell your whole portfolio, you could generate a ton of both short and long-term capital gains taxes if you're trading in a taxable account. You interrupt your compounding if you're a younger investor, which is not what you want to do. You create stress and potential regret for yourself. So as my friend Chris Dunn always says, trade less, profit more tends to be a much better strategy for most people. And certainly you're not going to see me selling all my stocks at once. I don't think I've ever done that. I don't think I ever will. Sometimes maybe I'll put some hedges on, but I'm certainly not going to try to blow out of all my positions at once because it's probably not going to end up turning out very well for me. So hopefully that's useful. I hope you found today's video interesting. If you've got any follow-up questions, let me know in the comments. Let me know if this was useful, if this was interesting, what you want to see more of, and if you've got any thoughts on the portfolio holdings. I'll see you in the next video. Cheers.